Dissecting Stripe, a blueprint for the protocol future of payments. Introduction, the surgical impulse. There's something unsettling about dissecting a success story. Stripe is one of the most admired companies in Silicon Valley, a poster child for frictionless UX, clean developer APIs, and the elegance of making money move with a few lines of code. But beneath the sheen lies something more telling. Stripe didn't fix payments, it abstracted their dysfunction. This isn't an indictment. It's a recognition that Stripe, for all its brilliance, is a sophisticated wrapper, a kind of internet scalpel that makes it easier to operate on a deeply scarred body, the global payment system. Our aim here isn't to tear Stripe down, it's to reverse engineer it, extract the logic that made it work, and ask a deeper question. What comes after Stripe once we no longer need to wrap a broken system in elegant code? In this piece, we dissect Stripe with surgical precision, not to admire the anatomy, but to understand its dependencies, limitations, and what its very structure reveals about the fractured, rent-seeking layers of modern payments. From that dissection, we draw a blueprint, not for another platform, but for a protocol, one that doesn't ride on Visa, doesn't bow to IBAN, and doesn't need legacy rails to justify its existence. This is a post-mortem with purpose, a blueprint born of blood. Let's begin. Section 2, Stripe's MVP, a clean wrapper over a dirty system. Stripe's genius wasn't in inventing a new payment rail. It was in making the old rails bearable. When Stripe launched, the world of online payments was dominated by bloated processors, manual merchant onboarding, opaque fee structures, and integrations that felt like dental surgery. Stripe changed all that with a simple proposition. Paste 7 lines of code into your site, and you can accept payments instantly. It was elegant, developer-first, and radically easier than anything else on the market. That was the minimum viable product MVP. Card payments via a clean API, instant onboarding, transparent pricing, hosted checkout, or native integration. But what made it viable wasn't technical brilliance alone. It was compliance with the old gods. Stripe didn't create new infrastructure. It interfaced with Visa and Mastercard, who themselves interfaced with legacy banking rails like SWIFT, ACH, and SEPA. Stripe became a cloud-native payment wrapper, but the actual movement of money remained trapped in 20th century rails, intermediaries, and settlement delays. So Stripe's value wasn't in disintermediation. It was in re-intermediating a terrible experience into something tolerable. The trade. Stripe absorbed complexity, developers built faster, Stripe masked fees, merchants accepted the cost. Stripe enforced card dependency, users swiped as usual. Behind the scenes, the entire payment stack remained intact. Card networks still took a cut, banks still routed through slow, siloed systems, FX still meant hidden margins and delayed settlement. And Stripe, for all its abstraction, charged its own toll at the very top. Stripe's MVP wasn't a new rail. It was a UX bandage on a fractured skeleton, and that's what made it powerful and vulnerable. Section 3, Anatomy of a Rent Stack. Once you peel back the elegance of Stripe's API, you find yourself staring into a dense ecosystem of middlemen, each positioned like a toll booth on the path between customer and merchant. The money moves, but not before being taxed at every checkpoint. Let's trace a simple $100 card payment. The customer swipes their card, Visa, Mastercard, Amex. The merchant's acquirer bank processes the transaction. The card network routes the payment to the issuing bank. The issuing bank authorizes and settles. Stripe packages the whole mess into a clean developer experience. The merchant receives $96 to $97, sometimes days later. The customer thinks they paid $100. The merchant sees less. And a cascade of rent seekers make it possible for a fee. Here's how $100 breaks down. The issuing bank, the one that gave the customer their credit card, takes between $1.50 and $2. The card network, like Visa or Mastercard, takes about 10 to 30 cents. The acquiring bank, which works with the merchant to accept payments, takes another 20 to 50 cents. Stripe, which makes the whole process easy for developers and online businesses, takes 2.9% of the total plus 30 cents. That's roughly $3.20 on a $100 transaction. The merchant who actually sold the product or service ends up with what's left, usually around $94 to $96. So while it looks like the customer paid $100, the business sees noticeably less, and most of it disappears into a stack of legacy toll booths. This is the rent stack, a carefully constructed ecosystem where each participant justifies its fee with the promise of trust, risk mitigation, or convenience. And it all hinges on one thing: the card. The card is the identity layer, the routing key, and the trust signal. But it's also the bottleneck, a fragile piece of plastic abstracting access to a legacy bank account, itself bound by region, regulation, and compliance layers thicker than molasses. Stripe made this stack bearable, but it didn't eliminate it. In fact, Stripe's success helped entrench it further by making it easier for developers and merchants to plug into the rent stack without ever seeing the wires. This is the paradox. Stripe was the most elegant way to comply with a broken system. But once you see it clearly, you can't unsee it. And the next step isn't optimizing the stack, it's obliterating it. Section 4. The plastic empire beneath it all. The card. A 16-digit number embossed on plastic, backed by a brand logo and a bank account. It's not a piece of technology. It's a symbol of submission to a payment hierarchy we didn't choose. Visa and Mastercard built empires not by creating a new financial system, but by positioning themselves as indispensable mediators between merchants and money. And they've done it masterfully. Their value lies not in moving funds, that's still the banks, but in providing a standardized global interface for trust, identity, and risk. You're not swiping your card because it's secure. You're swiping it because everything else was made deliberately harder. Stripe, for all its modernity, is still dependent on these card networks. The clean interface doesn't hide the fact that beneath it lies a plastic-based monopoly built to extract. Let's revisit the structure. Card networks, Visa, Mastercard, are wrappers over bank accounts. They create the illusion of innovation with branding, rewards, and speed. But in reality, they ride on SWIFT, ACH, SEPA, and other inherited fiat rails. Banks own the card networks. The networks reinforce the banks. The moat is circular. The fees are permanent. And when you travel, use your card abroad and you enter a maze of international card surcharges, currency conversions, interchange uplifts, and FX fees. Even if both you and the merchant use Visa, the transaction can cross multiple banks, each taking a cut for doing nothing but passing a message. This is not payments innovation. This is the perpetuation of payment friction, sold with a touch of holographic branding. Chargebacks are another false virtue. Promoted as consumer protection, they are in reality a risk offload from the cardholder to the merchant, arbitrary, often abusable, and mostly skewed toward larger issuers. Non-existent in direct bank transfers or crypto, where finality is the rule, not the exception. And what about QR codes, aliasing, or direct wallet-to-wallet settlements? Card networks actively avoid these, not because they can't implement them, but because they cannibalize the moat. The plastic empire survives, not because it's best in class, but because it controls the default settings. But that default is beginning to rot. And elsewhere, a protocol layer is emerging, not to replace the plastic card, but to make it irrelevant. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. The map of monetary fiefdoms. If Stripe is a wrapper and Visa is an interface, then beneath it all lies the geopolitical substrate of money itself, fragmented, regulated, and fiercely territorial. What most people experience as global payments is, in fact, a maze of sovereign payment silos, stitched together by rent-seeking intermediaries and heavily surveilled bridges. We are not operating on a unified financial internet. We are navigating a medieval patchwork of monetary fiefdoms. Let's name them. SWIFT block, the legacy core. This is the domain of USD hegemony, the US, EU, UK, Japan, Australia, and their allies. SWIFT doesn't move money, it moves messages between banks that trust each other. Real settlement happens behind the curtain via ACH, Fedwire, SEPA, FPS, and other regional systems, all running on compliance-heavy rails. It's orderly, but glacial, secure, but extractive, and utterly unfit for a digital-first world. BRICS block. The rising alternative, China's SIPs and Russia's SPFS, are direct responses to SWIFT dependency. India's UPI and Brazil's PIX are ultra-efficient domestic systems, but friction returns the moment you try to move value across borders. This bloc doesn't want faster payments. It wants monetary sovereignty and rails it can control. ASEAN, Middle East, the hedging hybrid. Southeast Asia and the Gulf states play both sides. Singapore, UAE, and others have built modern rails and are integrating selectively with SWIFT, with SIPs, with crypto. Everyone is watching to see who offers the best deal for cross-border trade. Africa, the fragmented frontier. Africa is both broken and brilliant. Legacy banking is weak, mobile money is dominant, and crypto often fills the trust gap. Systems like PAPS aim to unify intra-African settlement, but fragmentation and capital controls persist. This is fertile ground for protocol-native finance to take root. Crypto, the stateless disruptor. Here, everything is different. No country, no bank, no closing hours, no FX conversion delay, just wallet-to-wallet, atomic, irreversible settlement. USDT, BTC, ETH, DAI, money in its purest programmable form. No matter your location, all you need is a private key and a network connection. That's why crypto is feared. It isn't faster or cheaper by accident. It's faster and cheaper because it refuses to participate in the fiefdoms. The implication: there is no global payment system, only friction-dense interoperability between monetary kingdoms. Stripe operates inside the SWIFT block. Visa bridges a few gates, but crypto walks around the wall, permissionlessly. And once people figure that out, capital will go where the gates don't exist. Section 6, Inference. Capital will flow to where it's treated best. Money is not loyal. It goes where it's respected, multiplied, and unshackled. For decades, capital had no choice. It was born in banks, fenced by borders, and herded through rent-laden channels. But now, the gravitational logic is shifting. Once stablecoins unlocked frictionless, instant dollar mobility, once DeFi protocols started offering 4 to 8% real yield on idle assets, once wallet-based payments became faster and cheaper than Visa swipes, capital saw the light, and it started moving. Yield gravity is real. A U.S. savings account pays you 0.01%. A money market fund pays 5%, but only if you jump through institutional hoops. A tokenized MMF protocol backed by short-dated T-bills gives you the same instantly on-chain, globally accessible 24/7. There is no debate. Programmable, composable, yield-bearing crypto assets are more attractive than dead capital in a fiat account. Even if you only keep cash-like amounts in your wallet, over time, the logic inverts. Fiat becomes just the on-ramp. Crypto wallets become your treasury. DeFi protocols become your fund manager. Why would you go back? Once you've paid with a QR code from your wallet, earned interest automatically, moved funds globally in seconds, avoided banks, FX spreads, and KYC nonsense, you start asking, why would I off-ramp at all? Coinbase becomes a fallback, not a necessity. Banks become the legacy compatibility layer, not the source of liquidity. The network replaces the institution as the keeper of trust. But institutions have baggage: sovereign wealth funds, insurance companies, pension administrators. They're not ready to hand over $100 billion to a MetaMask wallet. They want custodial services with names they can sue, insurance, auditability, access control, workflow tools for compliance and oversight. So even as capital flows into crypto, it first passes through trusted custodians: Coinbase, Fireblocks, Anchorage. These players will abstract away key management, create access-controlled DeFi dashboards, offer secure connections to protocols like Aave, Uniswap, Ondo, call it CDeFi middleware, the airlock between TradFi's paranoia and DeFi's permissionlessness. The inference is inevitable. All capital flows toward logic. Logic favors liquidity, programmability, yield, and sovereignty. That means crypto. The pipes are being laid, the rails are active, and even the old guard will follow the flow. Because capital doesn't care about nostalgia, it cares about multiplication. Section 7. Custody, confidence, and the coming institutional shift. If the crypto ecosystem is a roaring river of capital efficiency, then traditional institutions are like oil tankers parked on the bank, massive, slow, and terrified of getting wet. But they can't afford to stay parked. Pension funds, insurers, sovereign wealth managers, they're all governed by one primal mandate: don't lose the principal. That's why they move slowly, why they demand regulation, and why they outsource custody to whoever can guarantee security with a signed liability clause. And yet, even these cautious giants are beginning to pivot. The rise of CDeFi middleware firms like Coinbase Institutional, Anchorage Digital, Fireblocks, and Zodia aren't just safekeeping crypto, They're building bridges between cold compliance and hot yield. They provide multi-user custody, CFO, auditor, compliance officer, all with discrete permissions. Protocol integrations, yield vaults, lending pools, tokenized T-bill vaults, audit trails plus insurance, so no board member gets fired for touching crypto. This is the compliance layer for institutional DeFi. It's not sexy, but it's the key that unlocks the vaults. Multisig Treasury is the new bank. Why would a sovereign wealth fund park billions in Citi when they can set up a multisig Gnosis safe, whitelist only verified dApps or investment strategies? Define roles: initiator, approver, rebalancer. Access tokenized short-term yields plus real assets in real time. No bureaucracy, no settlement delay, just a programmable vault, transparent, verifiable, composable. This isn't the future. It's already happening. The institutional hangups. But even now, institutions hesitate because they fear key loss and protocol risk. They distrust unaudited code. They don't want a junior employee clicking confirm and losing $10 million. So for now, they insist on wrapped crypto exposure. ETFs, tokenized funds, structured notes with crypto-like returns. That's fine. On-ramps will continue to monetize the comfort gap. But over time, the pressure builds because the return delta is too wide. Eventually, someone breaks ranks and jumps in directly. And when that happens, the others follow. Fast. A new normal emerges. Banks will become compliant custodians of crypto wallets. Treasurers will have protocol access dashboards. QR-native payments will merge with yield-native storage. The corporate treasury becomes a strategy engine, not just a vault. In short, institutions won't kill DeFi. They'll professionalize access to it. And the moment they get comfortable, the old payment rails will look like rotary phones. Section 8. Blueprint. What comes after Stripe? Stripe's genius was abstraction. Its fatal flaw? It abstracted the wrong thing. It made legacy card rails feel modern, but it didn't question whether those rails should exist in the first place. What comes next isn't a better wrapper. It's a clean sheet protocol built on 3 core principles. 1. Bank-to-bank protocols, optional, not foundational. Let's call it IBAN 2.0. If 2 parties want to transact in fiat without card networks, present a standardized QR code encoding the destination account, resolve payment via FPS, SEPA, or UPI, instant, direct, low fee, add metadata, invoice ID, memo, confirmation hash. This is not revolutionary, it's table stakes. The real protocol lives 1 layer up. 2 wallet-native payments with alias resolution. Instead of card numbers or account digits, use human-readable aliases, like ENS or pay names, QR codes or NFC tags tied to wallets, composable metadata, e.g. invoice hash, payment purpose, location. Funds move wallet to wallet. Settlement is atomic. Identity is abstracted. And yes, you could still use a bank account as a fallback, but wallets become the default, not the edge case. 3. Yield integrated treasury by default. Don't just hold funds, deploy them. When idle, funds auto-route into yield-bearing stable vaults. Need them back? Instant exit, no slippage. Smart wallets equals savings plus liquidity plus composability. No CFO wants to manage this manually, but they'll love a UI that does it passively, securely, compliantly. Think of it like Stripe plus Plaid plus Aave plus Gnosis Safe, but under 1 protocol surface. Bonus layer, AI as Treasury Copilot. Alert, you're holding $420,000 in idle USDC. Move to Ondo T-bill vault. Forecast, expected foreign exchange exposure to euros exceeds 8%. Hedge via protocol XYZ. Action, 3 vendors now support direct wallet payment. Reroute and save 2.5%. Stripe made payment APIs. What comes next is financial coordination agents. This is the post-abstraction phase where money moves, multiplies, and manages itself. Stripe was the gateway drug, but the protocol age of payments is here. And it doesn't care about card networks, compliance stacks, or legacy excuses. It cares about composability, clarity, custody, and control. The dissection is complete. The blueprint is drawn. Now we build. Section 9, Conclusion. From wrapper to weapon. Stripe helped civilize a chaotic corner of the internet. It made online commerce accessible, friction-light, and developer-friendly. But it never challenged the underlying power structure. It simply taxed a system already built to extract. Now, the walls are cracking. Capital is flowing into crypto because that's where logic lives. Wallets are replacing bank accounts because that's where sovereignty begins. Protocols are replacing platforms because that's where the moats disappear. This is not an evolution of payments. It's a revolution in monetary architecture. And the mission now is not to build a better checkout. It's to build a programmable, composable, wallet-native financial layer that anyone can plug into: person, merchant, sovereign, or AI. Stripe was a bandage. Crypto is a new circulatory system. And the next builders won't abstract legacy. They'll obliterate it with clarity, custody, and code. The wrappers are dead. Long live the protocols.